Here we go, round 5. Just 3 rounds to go. Man, is anybody gonna catch Chester? I'd say that given the results of the last round, that let's put it this way: I think Chester will have to stay on top of their game in order to stay ahead. So that means that I think that there are opportunities for other teams to perhaps catch up to them. But got to start doing things right. Missing out on all kinds of small opportunities and little things that can make huge differences. And maybe we'll kind of subtly look at a few things like that. I hate to give away too many secrets, but they're not really secrets. They're all right there in black and white. It's just oftentimes recognizing those and then putting them to good use. So let's look at last week's assignment first. Had 5 questions. Number 1 was Ferris had the highest sales by about $42 million, but Chester had more earnings before interest and taxes. What's the main reason? Contribution margin, right? Contribution margin was a huge difference there, right? This was last round. Ferris was 28.3 on the contribution margin. Chester 34.9, so a 6.6% difference in contribution margin, right? Their sales are different, so it's kind of hard to say 6.6 of what, but just based on Chester's sales, having a 6.6% contribution margin would be about $14 million extra in earnings before interest and taxes. That's just really quick off the top of my head, but it's going to be in that ballpark. So huge difference there, right? So huge bump up. On the other hand, Ferris gained a little bit back because they had a little bit better SG&A to sales number. They probably spent about equal amounts. If we looked at it, probably close, but Ferris had higher sales, and so the ratio would go down a little bit. But the question, and this is always a question that goes on daily in real life, is Ferris perhaps running maybe prices a little bit lower in order to attract more business, and so they're getting increased sales, but maybe not as much margin, right? That's an everyday thing that happens, right? Walmart, always the low price. You look at their margins; they're pretty narrow. They sell over $400 billion worth of crap every year, and they only make I forget what they make, 20 billion or something like that. 20 billion sounds like a lot of money, but when you're selling $400 billion worth of crap, that's fairly narrow margins. When you look at, for example, Microsoft sells $75 billion worth of stuff, and they make like $30 billion a year, right? They make more money on far less sales because of the difference in margins. So, but there we're comparing, 2 different industries. Here you're looking at the same industry. What will be the total industry unit demand in the high end for next year? Just some basic math. Should be 5,000 or 5,707,000. Okay, and that's just not supposed to be a minus sign, but it's last year's demand was 4,853,000. The growth rate's 17.6%. So the easiest way to do that math is to just multiply the 4,853 times the 1.176. Right. You can multiply it by the 17.6% and then add, the 4,853 as well. So there's other ways to do the math, but the easiest way is to do that, and the answer is about 5.7 million. So 3 is, what's Digby's after-tax cost of its TQM investment for this round? Again, I like you to keep looking at the effects of taxes in our investments, and how those investments are affected by the taxes. In effect, we reduce our investment amount because we get a benefit of taxes. It seems kind of counterintuitive, and it is, that our taxes are set up that way. But
where did you get the $15 million at?
15 million is what Digby invested, wasn't it? Or did I put the wrong amount down?
Because I thought it was $12 million.
Let me see. Maybe I was looking at the wrong amount. Digby, 15 million in TQM.
Okay.
Total expenditures. Okay. Might have been the prior round they did 12. but they did 15 million. So Digby's after-tax cost of its TQM investment, again, the easiest way to do it was they had a $15 million investment times 65%. The tax rate's 35%. Okay, the tax rate's 35%. Technically, you would take the 35% times the 15 million, and then you would deduct that amount from the 15 million. The short way, when you do your algebra and condense your equations, is to just take it times the 65%. So their after-tax cost is just below $10 billion. Okay, just below $10 billion. Okay, what's Chester's strategy? My take on it, would be that it's broad differentiation. They haven't left any market, right? They're pushing the front edge, especially the high performance and size, and they're trying to be pretty competitive in the low and traditional segments. They're certainly not a low cost. Broad low cost. I don't think that they're really trying to push the low cost. They're not investing a ton of money in automation. They are investing a lot in TQM, but they haven't been invested a lot in automation. Okay. If you had some other arguments and you wanted to argue that, I'd listen to the arguments for sure. But based on what I'm seeing, just looking, in fact, if you just look at the perceptual map, I think you get a pretty good idea that they're probably a broad differentiation. They're certainly not life cycle. Life cycle, you'd be introducing some new products, and they're certainly not a niche differentiation, because then they wouldn't be competing as much in the low and traditional segments. Okay. So we can rule out a bunch of them, and it kind of gets us to this broad one. 5, probably the more complicated one. Suppose Chester had bought back 200,000 shares of stock. Assume it could have done this with available cash. What would its earnings per share have been? What would have been the effect on ROE? Okay, the first one requires a numerical answer. The second one, I said I didn't really necessarily need that. But their earnings per share simply would have increased to $10.47. So if we go look at Chester, the math here is pretty simple. It's just like the story problems, though, that you had from grade school, right? It's not that the math is difficult, it's just sometimes figuring out what the problem's asking for, right? Okay, so we come up and we look at the stock market summary here, and Chester had 2 million shares outstanding, right? Okay, and they made $9.43 per share. They made profit, is probably a number that we need here. Net profit of 18 million. If I bring my calculator into play here, then what I'm saying is that they still made $18,853. And if they'd bought back 200,000 shares, they'd have gone from 2 million shares to 1.8 million shares, right? Everybody buy that? So divided by, and I'm going to leave out the last 3 zeros on both of these numbers. Okay, so I can say that oops, I'm sorry. I got to go 1,800 then in that case, right? Because this would have been 18 million in terms of profit, and this would have been 1.8 million, so I'll leave off the last 3 zeros. And I get $10.47, maybe a little bit of change. So would increase their earnings per share by about $1, right? About $1. Okay. And that makes sense. You're increasing your earnings per share about 10%. You're reducing your stock by about 10%, right? I mean, it's fairly straight. It's not a perfect relationship there, but it makes sense when you look at it that way. So, okay. Questions about last week's assignment? Oh, the last question then was, what would have been the effect on ROE? And that doesn't require a numerical answer, but ROE would have increased, right? Okay, because cash would have decreased. What happens? Let's go look at that balance sheet, because I think this is kind of important. So, if they spent whatever. Okay, I don't know what it would have cost to buy back the stock. It doesn't matter. But let's just say it's 20 million. Okay, their cash would go down by 20 million, so they'd only had 9 million in cash. Their total assets would have decreased by 20 million, so they'd have 20 or 70 million in total assets, and their total equity would have decreased then by 20 million. Okay, when you get rid of the cash like that, you reduce all of those things, right? You reduce your current assets, you reduce your fixed assets, and you reduce your equity then by equal amounts. And so they would have reduced all of those by 20 million. They'd had $60 million is all in total equity. That would have made their ROE about 30%, right? Because they had 18 million in profit, 60 million in equity. Divide 60 million into 18 million, it would have been about 30%. So their ROE, if we'd have done the math, part of it would have gone up from 23 to about 30%. So it would have made a huge difference in ROE, right? Cash is not always king. Right? We like to have cash. Cash is good. It gives us a certain amount of safety, all those other things. My guess is if we'd have gotten rid of that 20 million, their leverage, for example, might have exceeded the limits that I've placed on that. Their working capital might not have been high enough. There would have been risk that they'd have been taking on. And you could argue that that risk may pay off. It may, okay, but it's risky nonetheless. So those are all the decisions the managers get to balance every stinking day. The trade-offs between risk and return. And, you know, sometimes you put your butt out there on the line, and sometimes it pays off big time, and sometimes you lose big time, though, too. So, questions about the assignment then? Okay. Let's go take a look, see what happened in round 5. I'll try not to answer too many of the questions that I've asked on the homework, but you guys know every now and then I screw up and answer a question for you. So, sales. Chester almost caught Ferris here. Ferris's sales didn't increase by that much, right? It looks they went from what, 268 to 278, so a little less than 4% increase in sales. Not that impressive. Chester had a nice increase, about 40 million, so it's that 15% increase in sales. Not too bad, because the overall growth rate's about 14%. So if you're going to keep your market share, you want to grow about 13, 14%. Ferris lost market share, right? Even though their sales grew, they lost market share. I don't know who picked that up. I know Chester, but they picked up a proportionate share, and so some of the other teams must have picked up. I think Digby gained a lot in sales, maybe this round, if I'm not mistaken. We had every team had a profit except Andrews, but pretty small loss, really, less than $1 million. So, but every other team had a decent profit. Chester on top of things again, 30 million. Next, almost double Erie's, right? Almost double Erie's. And certainly because of the way they've handled their stock, they're going to have more than double in terms of earnings per share. We see some pretty impressive contribution margins. Okay, we're starting to get up there. Round 5, we still got 3 rounds to go, but we're seeing every team except Ferris is over 30%, and 1, 2, 3 teams are over 40%. So that's fairly impressive. I'll tell you, it wouldn't be unusual to see contribution margins exceed 50. I've seen them go as high, overall contribution margins as high as maybe 60-some%, so that is possible. I'll also tell you, we talked about this in another class, sorry, but some of these students have multiple classes from me, and we were BSing a little bit about it. I will tell you that Baldwin, had they done a few little things, they could have easily increased their contribution margin without adversely affecting their sales and other stuff. So even though they're the highest, they're still leaving a bunch on the table in terms of contribution margin with some real simple changes that could be made. Okay, and some of those we might take a look at. Okay, what else we got going on up there? Profits, ROEs, 27%. That's awesome. 12, 13% would be pretty good. I'd be happy investing in a company that had a 12 or 13% continuous ROE. But boy, give me 27% ROE, I'd be ecstatic, right? If I had a company that was returning year after year 27% ROE, I would bet the farm. Okay, if I could count on them doing that consistently, right? Now, unfortunately, in the real world, it doesn't usually last forever. Although I would. Apple has probably exceeded this for the last 10, 15 years, right? And obviously, if we could, in retrospect, go back and invest in Apple 10 or 15 years ago, we'd all be really, really wealthy. But we weren't, unfortunately, smart enough to do that. Of course, you guys would have just been in grade school back then, so you probably didn't have any idea. Although you probably knew more about Apple than I did even back then. So, stock market summary. I'm not sure if these guys are still selling shares or not. Digby has stopped. We see Andrews, Baldwin, Chester still hanging in there. The earnings per share, yeah, Chester 15, and I said more than double of Erie, right? They had pretty close. They had about double the profits, but 2.5 times the earnings per share. So, and that's again because Erie has 2.6 million shares outstanding. Chester only has 2 million shares outstanding, so makes a difference. Stock prices, ooh. And we're really seeing the computer team start to level off. So there's some ripe fruit, low-hanging fruit out there, guys. Chester so far is the only one picking that fruit. But for the rest of you teams, the fruit is there. It's ripe. It's hanging low to the ground. You should be able to pick it off. Borrowing. Look at that, lots of debt. That's kind of cool. Chester, of course, Chester's winning, and they don't have a lot of debt, so you might say, well, boy, that shows that you shouldn't have much debt. But again, I'll say that I think after looking at the results of this round, that there are opportunities for other teams. So Chester's going to have to be on their game, okay? And I think I even asked one question in the deal, but of course they don't have to answer them, so they won't learn a valuable lesson because they didn't have to answer the questions that the rest of you guys are going to get to answer. So, look at that. We still see huge investments by Erie and Ferris. Relatively big investments by other teams, but huge investments by Erie and Ferris. What are they investing in? You guys need to take a look at that. You probably should have an idea where they're going. While Chester's beat them the last couple rounds, they're certainly not going to go away, right? So you're still very much competing against them. Long-term debt issued. Boy, that's a huge. Look at that. All 6 teams combined, minus Chester, which didn't issue any long-term debt, but we see a lot of long-term debt got issued. Not that much current debt, although it is interesting that while, remember up above, we saw that Chester wasn't issuing any long-term debt. They issued $30 million in short-term debt, and Erie and Ferris also issued some short-term debts. So it'd be wrong to say that they're not relying on debt. They've just chosen to look maybe at short-term debt versus issuing some long-term debt, right? Because in fact, the amounts were bigger than, as big as Baldwin and bigger than Andrews or Digby, so they are issuing debt, just doing it in a little different fashion. Changes in cash position, so even the leading teams there. Digby's the only one who really had a positive change in cash position, so they probably won my cash flow wars. But Chester, Erie, and Ferris are all sitting on a decent amount of cash. 20. You always want a little bit of margin, and so at this stage of the game, 22 million is not a hell of a lot. That's a reasonable amount of cash probably to be sitting on. I'd say that Erie and Ferris, that maybe be a little too much cash. So, accounts receivable, inventories. Chester had the biggest inventory. Okay, so it's a good thing they borrowed some money because they had quite a bit of inventory, really. So even though they had the highest sales, okay, they also are hanging on to a decent amount of inventory. Ferris had the next highest, Ferris had the highest sales. Chester was the next, but both of those teams have a lot of inventory. Might be something to be said for that, though. Okay, again, had you had this kind of inventory left over after the first round, if we went back to round 1, that'd be a huge amount. That'd just kill you, right? We're in round 5, and sales have pretty much doubled or close to it, maybe, right? Since the start of the game. So 34 million, while that's quite a bit of inventory on hand, it's certainly not a killer as we saw, with the overall results. Fixed assets, yeah, as we might expect, with the amounts that Erie and Ferris have been investing, you got huge plants, right? Huge plants. Chester, a pretty good sized plant, but quite a bit smaller than Digby, interestingly. Again, we go back and talk about efficiency. and Chester's far more efficient than Digby at this point in time. There may be some things Digby's doing that make us nervous. We'll have to take a look and see. Accounts payable, that's pretty much because I don't think anybody's fiddled with their accounts payable accounts, which you guys can fiddle with, but I don't think anybody has. So that's pretty much a reflection of your sales. And current debt, Digby's got 0 current debt, so that's interesting. Long-term debt, kind of all over the place, but we get down here to total equity. And this is, again, you guys look at this as small, and if you were a company, you say, oh, geez, see, we got more equity, we're stronger, more powerful, more valuable. All those things would be true, but this also represents a lot of opportunity, right? A small company can more easily generate earnings per share, can more easily generate ROE. Okay, a small company can more easily do those things. It becomes more difficult as you get bigger to generate those types of things. Okay, earnings per share, yeah, we'll see. That could change, depending on what you do with the shares outstanding and whatnot. So, income statement. What was I looking at earlier? We're seeing some pretty big interest payments. Big depreciations because of the size of the plants and whatnot. Chester, the only team that doesn't look like invested any money in TQM now, but maybe they've maxed out, but other teams might be catching them. Okay, 3 teams that are winning are not sitting around with unused capacity. Okay, I don't think I asked this question, but I might. I thought about asking it. It might be one for the future, but what are the costs related to unused capacity? Right? So you got, I would tell you that even Chester has, they have the ability to make about 13 million, it looks like, and they're making about 11 million. So even they have about 2 million units of unused capacity out there. Okay? And they're by far the best. Okay? So there's lots of unused capacity, and the question might be, is what are some of the costs associated? Because it's easy for us to look at, like, say, our labor costs, and we got to pay time and a half, and we think, oh my God, I don't want to pay time and a half, right? But what are some of the costs that might be associated with having idle capacity? Might be a better way, because you're using it for the first shift. It looks like almost everybody's using at least their first shift capacity. Not quite. Digby's not using their first shift capacity, and Andrews is not quite using their first shift capacity. What are some of the costs then with having idle capacity? They're not as readily seeable, right? Okay, but they are very real. Okay, they're extremely real. There's just huge costs associated with not using that capacity. They're just a little bit harder to ferret out, a little bit harder to sharpen your pencil and actually find those. But to me, when you look at a chart like this and you say, let's see, Chester was the winning team, Erie or Ferris was second, the other was third probably, maybe. We'll take a look at my score sheet. It might be a little different than that. But these 3 teams are doing pretty well, okay, and they're using capacity to a greater extent than the other 3 teams. Okay, scratch your head. Inventories. Traditional, quite a bit of inventory left in the traditional segment. Have to do the math there because there is quite a bit there. Looks to me like 3 or 4 million units in the traditional segment. Not too many in the low, but a little bit in the low end. Not too many. High end, decent number of units left in the high end. Performance, not too many in the size though, so kind of a mixed bag in terms of the inventories and whatnot. We looked at Erie and Ferris. Kind of looks like they're adding, I'm just glancing, we'd have to go back and look at last round, but it looks to me more like they're adding capacity as opposed to automation. That's really the only 2 things for plant improvement are capacity and automation. If I'm looking at this, it looks to me like it's capacity. Erie certainly could have been adding some automation. I think they've been on a fairly steady chart of increasing their automation. Digby had a reasonable investment too. Hard to say. Part of Ferris's is a new product too, I'm sorry. So you got capacity automation, and I should have said new product, which is basically buying the capacity and automation for a new product, but but obviously they got a new product there. Digby looks like they might be doing some capacity and automation both. Okay, and they have lots of capacity, as we saw up above. Going on, Erie's dominating the the traditional segment. Not really a surprise. Erie is obviously a low-cost niche. Okay, so they're going to be really competitive in the low and traditional sides, and so they are dominating in the traditional. Kind of dominating here. Andrews kind of let them get away with it. You know, their potentials are pretty close. Andrews gave up about what's that, 17, about 5% of the market there. They allowed mostly Erie to get that because again, their potentials are pretty close. So Andrews kind of allowed it. They didn't make enough, and they probably ran out of product here in the low end. Gave up about 800,000 units of sales. So what's that? 800,000 units of sales times $20 would be what, 16 million? Yeah, 16 million, but your price isn't 20. It's a little less than that. So you probably gave up about 14 million in sales, something like that. Pretty big deal. Oh, I was one of the questions that's coming up. I'm going to run back and go over it here. I was looking at this. It's kind of unusual. If you look at labor cost, okay, I'm coming down. Typically, your traditional item should typically cost more. Boy, I'm seeing lots of places where it's not, so that's kind of interesting. But I picked on Baldwin in particular. Their traditional, the cost for their labor cost for their traditional product is actually quite a bit less than their labor cost for their low-end product. And so I asked you why. That's one of the questions that's going to be on your assignments. So, and I looked and I see there's other teams that theirs is the same, right? Theirs is actually their traditional is a little bit less there as well too. Okay, and their traditional is quite a bit more than their low, right? Lots more in terms of cost than the low end. And typically, their traditional product would have a higher labor cost, but in those cases, it did not. So. Low end, high end. Look at that. Ferris dominating in the high end. Digby a little bit. Chester kind of competing a little. But you only got the three teams competing. You got more products than that. Both Ferris and Digby have a couple of products. Probably why they're dominating. Chester's kind of picking up some scraps there, but hanging on tight with their one product. But that happens actually in the real world. You'll see teams that they just want to have one solid product maybe in a segment and concentrate on making that product good, right? And that can work out okay. It doesn't mean they're going to dominate in terms of sales. Where's their pricing at? They're actually a little less in price than the other ones, so. In the performance, right? Ferris still dominating, but kind of alternates here. Chester takes second, Digby in third place there. And then in the size, Chester dominates in the size category, interestingly. So of the three high-end categories, they kind of flop a little bit, although Ferris is towards the top in each one of those. So Ferris does a good job in the high ends. But Ferris has introduced new products in just about each of the segments, right? If they haven't already, they are in the process of, I think. So. Perceptual map. Starting to really give us some interesting insight. Ebb's outside the main circle. How did Ebb sell? In the low end. They were the top seller in the low end, even though they're outside the circle at this point. That doesn't mean throughout the entire year that they were outside the circle, right? It means by the end of the year, this is where it ended up. They were probably on the edge, or maybe just inside the circle, but then just moving, which tells us what? That is the placement of it really important? Not really, okay? It tells us that is their price the lowest? I don't even think it's quite the lowest. Is it the lowest?
And then their age is like 0.6.
Their price and their age are the two that are the most competitive, right? Which are the two biggest factors in the low end. So again, you just get back to that customer buying criteria. Okay. Now on the other hand, then Erie, which makes Ebb, has saved lots of money because they haven't been doing anything with Ebb, right? They've just been letting it sit there. Okay, so they haven't had to spend money on research and development. What's its MTBF? 12, I'll bet you it's 1,200, 12,000, whatever. Okay, yeah, so they got the absolute lowest MTBF because if you look in the low end, nobody cares that much about MTBF. So they're saving lots of money in material costs for Ebb, and because Ebb's back there, I'll bet you it's the lowest cost. Ooh, I hope I can back up that bet. Let's go see. Is it the lowest cost in terms of labor? It costs $8.22. Andrews is $9, just about $10 to produce. Bede's well over $10 to produce. Cedar's well over $11 to produce. Dell is close to $11 to produce. Okay, so my bet would have been really, really solid that Ebb is by far the lowest cost product to produce, right? So they can have a lower price and they can still garner a, let's get to that low end, what the heck's their, oops, I'm sorry, their contribution margin there, 52%. So 52% contribution margin, even though they're at the lowest price, right? They've still got the highest of any. Is that the highest of any individual product? Yes, it is. Okay, so they've got the highest contribution margin of any individual product that's being offered, even though it's the lowest or close to the lowest price of any product out there, right? So they've really concentrated, and as you can see, a lot of that, of course, has to do with the labor cost. But there's lower labor costs out there. For, I don't know about the low end, but there are some other lower labor costs. Well, EAT's got a lower labor cost, but they're also saving a ton of money here on the material costs. Right? And outside of those variable costs, they've saved a ton of money in research and development and those other things. Okay, so there's other ways that they've saved money with that product by really concentrating on the customer buying criteria. Okay, and concentrating on keeping their costs low.
So I have a question then in
Yep.
the low end segment, if you go back to the top products.
Okay.
Dell's age is at 1.59. And in the customer buying criteria, it's 7 is what they're looking for. So how are they even competing in that segment with their age being so low? Like, how are they towards the top of that?
So how is Dell competing when their age is so low? One, we'd have to take a look at last year. Okay, the revision date was 8/23. They might have made a big revision in it, so it might have actually been fairly old coming into that. I don't know. We'd have to go back and take a look at that and see if they made a decision. Ebb's going to have to make that decision. I'll talk about that in a second, maybe here. So that could be a part of it, but they're competitive otherwise. Their price is reasonable. It's it's kind of next lowest to Ebb, so their price is pretty reasonable. And the other factors do come into play. They're not spending much. They're certainly not spending much here on the promo, but they're spending a lot on the sales budget. Okay, so Ebb, for example, here's at 9.6, but Ebb's also just about outside of the deal. So this kind of gets back, and I'm hoping this kind of answers your question a little bit too. Ebb's going to have to make a decision here, or Erie's going to have to make a decision with Ebb. Ebb, maybe for another year, might sell okay, even being outside of that circle, but just okay. At some point in time when Ebb looks like it's kind of back here, actually the circles have moved, but they're going to have to make a decision, and they're going to have to bring it back into the fold. And I'm guessing that Digby made that decision and moved their product, Dell, forward enough that it did lower the age, but it's going to be positioned okay for the rest of the game, right? Okay. I don't know, has anybody got round 4 up? Take a look at where Dell was last year and see if that's kind of what they did maybe. And even Cedar at 3 years and 29, age-wise is not that great, okay? But they spent quite a bit of money on promo and sales, so that would have helped.
Andrews had like a perfect age.
What's that?
Andrews had a perfect age.
Yeah, the acre product was right, ended up being right at perfect. So it would have been a little young throughout the year, but by the end of the year, it's just about perfect. Should have a good December customer survey then, and it does, right? Because as of now, as of the end of the year, it's just right at the perfect age Andrew's product is. So they should hit the ground running, right? It's probably why they gave up, right? They sold out, could have sold another, what do we say, probably 800,000 units, right? Okay. Dell might have, did Dell take advantage of some of that? No, not really. A little bit. So they had a little bit of their sales were attributed to the fact that Andrews didn't meet their potential. We're seeing most of the teams, Andrews being the exception, have increased their productivity substantially. Baldwin especially, and Chester pretty well, Digby quite a bit. Okay, again, think of this in terms of savings on your labor cost, right? So if your labor costs running you 50 or 60 million a year, and it probably is, you're saving $5 or $6 million with this kind of productivity, roughly that 10%, right?
Would that percentage stay that way even if we didn't put any money into it?
Yes, yeah, that's going to stay. That's going to stay there, right? You can continue to put money into it and get that up even more. So, and likewise with TQM. Okay, again we're seeing Ferris not investing anything in TQM. That's kind of interesting. Probably one of the reasons Chester's kind of caught up to him quite a bit, right? Look at the huge difference in the demand increase, right? Versus Ferris and versus Erie. Okay, and so they're kind of letting things slide a little bit in that area, whereas we're seeing Chester has invested a lot, and we're seeing the other teams really coming on too. So Andrews and Baldwin and Digby are getting there. So, and I know there is a lot of diminishing returns kind of, and I don't know if Digby's at or Chester's at that point. They might be, but I know your game kind of tells you that at some point, once you've invested X amount in each of those categories, the additional investment probably doesn't give you the kind of return that you'd like to see. So, yeah. Okay, any questions, other questions then about the game? We got some good ones there going on. Did you go back and see where Dixie was or whatever last round? See if I'm kind of right about that.
They're right on the edge of that circle.
Last round. What was their age last round though?
That was a little low, right?
Yeah.
1.83.
I'll be darned. Yeah, so it wasn't the age thing.
Yeah.
Yeah, wasn't the age thing. So they just liked the price but they were still 4th or 5th on the list. So then the question you'd have to ask is, could they have sold 1 million more if their age was better situated? And the answer would be yes in that case, right? Okay, question for you guys. I know I had looked on Tuesday, but how many of you now have signed into CompXM? So there's a few of you that have not. Okay, anybody that hasn't signed in can't leave today until you're signed in, right? Okay, because I want to make sure that you're just signed in. I don't care if you start the game, but I just want to make sure you're signed in, that you've got through that process. I want to be able to answer the questions here if there are some, just to get you signed in, okay? Has anybody started? Anybody started around yet? Okay. Nobody wants to be the first guinea pig and tell the rest of the class what it's like, huh? It's similar to this game. They change things around. You know, you get different products and different segments. I think there's 3 segments instead of 5 or something, and you start with a couple products in each segment or something. So it's a little different, but it's a similar game in that, you know, what happens and whatnot. Yeah, Jordan.
When we start a round, we have to finish that.
I think if you start a round, you have to finish the round. You have to make your decision. But I might be wrong about that. It may be just like ours. You can save decisions and then come back and make decisions. You can start and stop the game. I know that. You know, I've never got to play it, so my guess is that you can probably start and stop maybe any place in, just like our game.
Okay.
Yeah. My suggestion would be probably if you finish a round, set aside the time to answer the questions because the questions pertain to the last round, and that way it'd be fresh. It'd be fresh in your mind. You'd probably do a little bit better on the questions if you do that. So.
So you do the questions before you go to the next round?
Yeah. Yep. Yeah, you'll have a set of questions, and it's not a ton of questions. You know, it's 10 to 20, I think, something like that. So, but all reports in the past have been that the questions are, and I can look at the questions. They're going to tax you. They'll be similar to maybe some of my questions in terms of, you know, going back and look at the financial statements and, you know, so. Okay. Speaking of some of my questions, let's go take a look at assignment for the 5th round. Ooh. Make you go back and read your guide a little bit. What would be the effects of extending the accounts receivable period from 30 days to 60 days? Okay. So what would be some of the effects? Kind of list the effects. I don't need dollar amounts here or anything. Just kind of, there's going to be more than one, right? There's probably going to be 2 or 3 or 4. Some may be good, some may be bad. Okay. Let me rephrase that. Some will be good, some will be bad. Okay, so if you just think of good things, then you didn't go far enough. So there's going to be at least 1 or 2 good things and probably at least 1 or 2 bad things. Okay. 2, what would be the effects of extending the accounts payable period from 30 to 60 days? Same thing, right? Probably some good, probably some bad. Okay. Again, going back and checking out your guide in those areas. The reading on it's going to be short, probably less than a paragraph. But it's going to tell you maybe some of the things that would happen if you did those types of things. I ask those questions because nobody's experimented with those, right? Nobody in the class that I know of. I don't.
Practice round?
Might have,
Yeah.
maybe a little. Okay.
Tells you right
Okay.
on the game if you highlight over it.
So you might be able to check. Mikkel's saying you might be able to check right in the game itself, right? The little red triangle things that pop up, the little pop-ups. So take a look at that. 3, if Erie would have paid a dividend equal to its entire cash balance, what would that have done to Erie's leverage ratio? So I want to take a look at leverage ratios here then. Okay, it's obvious that the leverage ratio would get worse or get higher, right? Because they're getting rid of cash. Okay, and they're paying out a dividend, so they're getting nothing in return for that. It's not an exchange; they're actually eliminating cash from their balance sheet. So it's going to make the leverage ratio go up, I guess would be the proper way to say it. So you guys need to, that's not the answer. I'm telling you that it's going to go up, so you guys need to do a little math there for me, right? Okay. Why were the labor costs per unit lower for Baker, the traditional, than for B? That's the question that I'd asked when we were talking about it a little bit. So get in there. There's probably more than one reason. And then 5, document some of the effects of borrowing money to buy back stock. Again, I'm not asking for a numerical answer here, but what if we borrowed money? I mean, you guys, you're getting over your reluctance to leverage a little bit, but what if you really did that extreme thing and you actually borrowed money to buy back stock? Now, I'm going to tell you that in the real world, Apple's borrowing money to buy back stock. They don't need to, but they are. It's again, it has to do with currency exchange rates and those types of things. Actually, it has to do with the onerous taxes that the U.S. charges on money that's earned overseas, and so they're electing to borrow money to buy back stock. Microsoft borrows money to buy back stock. Okay, there are lots of companies in the real world that borrow money to buy back the stock of their own company. Okay, so there's some really, really good, valid reasons to doing that. Okay, on the other hand, does it possibly make your company a little riskier? That is a possibility, but I want you guys to go through what are some of the things that happen. I'm looking at on the financial statement, okay? So I'm looking at it on the financial statement. What's going to happen if I borrow money I want real specific answers as to what happens on our financial statement, what happens on our balance sheet. Okay, shouldn't have any effect on the income statement. It's going to have an effect on the balance sheet. Okay. Questions about the assignment? Questions getting a little harder? Good. That was my goal. As we go along, the questions should get a little bit more difficult as we go along. Give you guys a little bit more to think about. Okay. Other questions? Oh, we didn't look at who won. Mikkel's giving me the look like, that was who won. She probably already knows. Round 5C, competitive round. There probably isn't a ton of suspense, so Chester, other than the contribution margin, again, Baldwin had a really nice contribution margin. 95.5 for Chester, so that's pretty good. The only things that got it were the contribution margin and the cash flow. Digby had a little better cash flow. No deductions. Deductions for Baldwin for both leverage and working capital. I think they were pretty close. So our winner, Chester, followed by Erie, followed by Ferris, or no, Digby, I'm sorry. So Digby did beat out Ferris this round. Baldwin wasn't that far behind, actually. Andrew's got a little making up to do. Okay, but you guys got your work cut out for you, though, to catch Chester. But I'll also say Chester has their work cut out for them to try to stay on top of the heap, because there has been some movement here that might allow some other teams to make a run. So, any questions? Okay, I'll try to send out the homework assignment today so that you guys can have it for next week. Couple of announcements. If anybody's got kids, or you know anybody that's got kids, if you want to come out and dye 3,000 Easter eggs tonight, come on out. We do it out at Saddle Butte Custom Smoking. It's a lot of fun, believe it or not. I'm the one that's responsible for ordering the pizza for all the kids and stuff, and so I order it at 6 o'clock when we start. And generally speaking, the kids are done dyeing the eggs and we've cleaned up before the pizzas arrive. It gets to be really, really tough sometimes keeping the kids active or happy for the few minutes while we're waiting for the pizzas. They dye them that quickly. It has always been a shock to me that you could dye 3,000 eggs or close to it inside of like a half an hour. So it's really crazy. It's a lot. The kids just have a blast. So that's going on tonight. The Easter egg hunt or roll or whatever is going to be Sunday at 1 o'clock at the Optimus Park. So that by, if you think it's fast dyeing the eggs, it's never taken more than 5 minutes for the kids to pick up all the eggs, even 3,000 of them at the Easter egg thing. I've timed it in the past. It's taken less than a minute sometimes. It's like this human vacuum cleaner just crossing the field. It's just insane. So it's a lot of fun. There's a dinner. No, that was last night. The athletic dinner was last night, wasn't it? How'd that go?
Oh, good.
Good? Oh, you didn't go?
Yeah, it was good.
Okay.
Reeled in the rewards.
Yeah. Okay, any other events, any other announcements?
Isn't there something going on Friday?
Oh, Friday's the Spring Fling. It's here. It is sold out, I've heard. So it's sold out. It's a fun event. I'll be there, so you guys can see your business professor, maybe get drunk and stupid. I'm stupid all the time, so maybe I'll just have a couple of beers to give me a reason. So I'll try. My wife's the one that I gotta watch. She just, gosh, not that she drinks that much, but she just has one beer and then she goes crazy. She thinks we got all the money in the world. She starts buying things. Gosh. We got a bench from the Rocky Mountain Elk Foundation. It's a cool bench, but I don't know what we're going to use it for. Okay, other things? All right. Have a good Easter, everybody. If you're traveling, travel safely, and we'll see you next week.